All right, hey everybody. So in today's video, I want to take you through the ins and outs, nuts and bolts, and what have you, of compounding and discounting. So these are some concepts in finance that I think are very important for almost anybody to understand, probably anybody out there to understand how these things work. Okay, and a lot of times I've said this in a couple of my videos. A lot of times you don't really get exposure to a lot of finance topics uh, as a grade schooler, it's almost never touched on. Even the high schools, they don't even get into it. You would actually have to choose finance as a major in college to really understand this, or have just a personal interest in this kind of stuff. And you could go out and buy some books and learn on your own. That's another way to do that. But the average person probably has almost zero understanding of what these things are. So I think in the new year, um, I am going to change the focus of this channel, and I'm going to try to focus a little bit more on financial topics and try to help people get educated in this area. I think it's very important. If you understand finance, you can make a lot of money and you can have a very decent life. If you don't understand finance, you can essentially have a miserable life. I know there's a lot of people out there with a lot of debt right now, and they're paying super high interest rate on the debt, and the debt is not tax deductible. So you are going to have to clamp down at some point and stop spending on these credit cards, or you're going to be in debt forever. Okay, it's really insidious um, how some of these institutions, credit card companies, and banks and whatever, you know, distribute these cards to people, probably knowing um, pretty well that the people are not going to be able to make more than the bare minimum payment, and they're going to pay for their purchases for years and years and years, and it's going to go on forever. Right? That's how these companies make a lot of money. Okay, so let's not go down that path, and let's go down the path of education instead. I think once a person's educated, you again, you're not going to fall for these traps. You're not going to um, fall down the pit and get stuck there for a very long time. So, what is compounding? Basically, it helps us project how much investment will grow over time given a specific rate of return. Okay, and compounding calculations are quite essential in many different areas, including finance, economics, accounting, um, basic management practices, just so we can understand how little or how great our investment grows over time, and understand the earnings and the payouts that these investments are making too. Okay, we'll see this in just a minute. What's discounting? It's kind of the opposite of compounding. It's all it is. It basically helps us determine the present value of a series of future cash flows. This is crucial for evaluating the net worth of any investment. Okay, any type of loan investment, we want to take everything, discount it back to today's date, and understand what is this investment going to be worth today. Okay, because the investment in the future probably will be worth a lot, hopefully, but not necessarily. You could invest in a house and it could depreciate. Most cars are depreciating assets, right? But if you undertake this investment, you want to know potentially how much you're going to earn, and also what is this thing worth today. So we can compare apples to apples. We want to get everything in today's dollars. Okay, and there's a few reasons for that. We'll get into that in just a minute. Basically, it just relies on the principle of the time value of money and net present value, not appreciated, abbreviated NPV. Okay, and we'll see a couple examples of that too. So compounding scenarios include, whoops, I spelled this wrong. Fix that, because I will share these notes with you when I post the video. We'll have all the notes here so you can copy and paste it and see how this works in your own Jupyter environment. So we have investment growth, savings account growth, retirement planning, investment planning, loan growth, right? Any kind of compound interest for fixed deposits, education savings, retirement savings, real estate investments, personal finance, right? Emergency funds, um, travel funds, things like this. When you want to go on vacation, you have to save up some money, probably, unless you're Jeff Bezos or Bill Gates. And you want to know how much your savings is going to earn, and can you afford to take this vacation, or when can you afford to take the vacation? Okay. And discounting scenarios include things like investment decisions, loan to mortgage valuation, project evaluation, any kind of capital budgeting will fall under this umbrella. Valuing bonds, retirement planning, valuing a business, right? That's kind of cash flow analysis for a business. How much is a business worth? You have to do that DCF analysis, or you just don't know, right? Pricing deferred payments, This could be some kind of insurance practice, right, where insurance companies have to save up a certain amount to pay out on life insurance claims. Um, what else? Home damage, damage to your car, um, medical insurance, all these things, right? So insurance companies will go ahead and try to do this analysis. They will do this analysis. They won't just try. They will do this analysis, and that's going to help them understand how much money has to be set in reserves so they can make payments on the claims when those claims come in. Okay, so let's look at an example of compounding. We have a very simple investment here. The present value is 10,000. The rate of return is 5%. This is going to go on for 5 years. Okay, and in this second example, we have a present value of 5 grand. The rate is 7%, so a little bit higher than this one over here. And it's actually paid out quarterly rather than annually. So if it's an annual payment, it's going to not compound as quickly. If it's monthly or quarterly, it's going to compound more quickly. And some of these are actually daily. I know my mortgage is compounding monthly. I think credit cards actually compound daily, which is pretty scary. Okay, that's terrifying actually. So there's our compounding. Now let's look at a scenario using discounting. Okay, so the present value, I'm sorry, the future value in this case is 15,000. The discount rate is 6%, and the time is 3 years. Okay, and we will get the present value. We want to do a DCF analysis and understand the time value of money. What is this investment worth today? And here's another example using the same logic, a little bit different inputs here. Future value is 20 grand. The rate of return is 4%, and the time horizon here is 8 years. Okay, so we can click it to refresh the cell. We can see the future value over here is 12,000, and this one was 10,000 on the initial investment of 5,000. Not bad. Okay, the initial investment here was 10,000, but the time frame was a lot shorter, right? So just 5 years. This is 10, and the discounting again. We're doing the reverse. We're looking for the present value. In this case, the future value is 15,000. Present value at 6% for 3 years is 12,000, and here future value is 20. Large, and for 8 years at a discount rate of 4%, it's worth 14,000 right now today. Okay, so this is an excellent example of saying which investment is better. You're going to invest 10,000 for 5 years at 5%, or you can invest 5,000, get a quarterly return, and the time frame for that investment is going to be double. Okay, but there's a lot less money put up at the beginning, so it's only 5,000 versus 10,000 here. You made it about 2,000 here. You actually doubled your money, so that's pretty decent, right? And these two investments, we can compare these very easily. If these were, now the structure is slightly different, right? But if the structure was a little bit more similar, and we see this one is worth 12,000 today, and this one we would have to pay 14,000 today, this would probably be the better investment, right? Because you're getting a higher return on your investment value, or you're just paying less. You're actually literally just paying less for that. Okay, let's look at a couple more examples down here. Now this one, I'm actually going to plot the results so we can see what it is. Okay, we have, again, hypothetical scenario, 1,000 invested. The rate of return is 5%. This is quarterly compounding. Future value is 2,000. And we are going to go ahead and run this analysis and then look at the plots over time. So here we're investing 10,000 for 20 years. It grows to 2,750. So you have a 275% return on your investment over 20 years. That's a pretty decent return, right? But it is kind of a long time. So I mean, it's nothing to get too excited about. But if you put your 1,000 away for 20 years in the bank and you're getting that kind of return, maybe a CD or something like that, that would be the outcome. And then here we have the discounting. So this is the opposite, right? The value of this investment today is about $800, and it would be worth about $1,800 in the future. So this goes the opposite way, okay? So we can even make this a little bit more dynamic. If I go down here and hit refresh on this cell, now this is asking me to input the initial principal amount. Let me put in 50,000. I'm feeling rich right now. I don't have 50,000, but that would be nice. Enter the annual interest rate. Let's do 10%, okay? just a hypothetical example, but this is very dynamic. So it's asking you for inputs, and as you answer all these questions here, it's going to do the compounding and discounting calculations for us. Okay, so a little bit more functional than the first example we saw, where we would have to go in and manually make these changes right here or right here, right, to all these variables, and this for the other thing that we looked at, and then down here the discounting, you'd have to change this and that. So this is nice because it's just asking for these inputs. So same calculation, same exact logic. It's just more interactive and a little bit more dynamic than the first example. Okay, so enter the number of years for this investment. I'm going to say 20 years, and enter the times the interest is compounded. I'll say one time. Realistically, it's probably once a year, maybe once a quarter, maybe semi-annually. It could be a bond investment that is paying us a semi-annual coupon payment. Okay, hit enter. Here is for the discounting side. Enter the future value. I'm going to say 50,000 again. So in the first example, I'm going to invest 50,000 today. I want to see what it's going to grow to in 20 years. This thing that I'm buying, this asset that I'm buying, is going to have a future value of 50,000. What is this thing worth to me today? The discount rate, I'll use 10% again. Number of years, I'll make it a little bit less. Okay, 18. I don't want to do exactly the same thing as what we saw above. And the present value today is worth $8,999. Whoops, what was that? $8,999, and the computer is freaking out at that amount. Not sure what that was. Okay, so we recovered. No biggie, no biggie. And you know what? Okay, so let me do this again because I think we did lose something there. Okay, the initial purchase amount 50,000. Okay, we're saying annual interest rate 10%, number of years 20. Okay, compounding once a year. That's fine. It's pretty realistic. So this investment of 500,000 is worth 336,000 in 20 years at 10% compounded once a year. And now for the discounting, enter your future value. Let's say 50,000. How much am I going to pay for this asset today? Discount rate 10%. Number of years, I will say 18 years. And today this asset is worth $8,992. That's what we pay for it today. And in 20 years, it will appreciate by 10%. For 18 years, it will appreciate by 10%. And in the future, 18 years down the road from now, it will be worth 50K. So why are these concepts needed? Basically, to understand exponential growth. Okay, compounding creates exponential growth over a period of time that you have to find. Reinvestment effects. I believe it was Einstein who said that compound interest was the eighth wonder of the universe, right? Or eighth wonder of the world. Maybe that's what it was. But if you keep on reinvesting the money and you don't take out those interest payments, you can see in the chart above, those compounding rates accelerate at an accelerating rate, okay? So the blue is compounding, the red is discounting. And why else would we need compounding, right? For effective decision making. So we can understand in a long-term scenario, 10, 15, 20 years, or whatever the case may be, how can our investment perform? We can have a lot of confidence over how we make our investment decisions, right? Because we can compare these investments to each other and say, this is a far better deal than this other one over here, and these are the reasons why, okay? So on the discounting side, why do we do discounting? To understand the time value of money, it's abbreviated TVM, to understand the overall risks of this investment that we are underwriting, okay? And just to understand the impact of inflation. So a dollar tomorrow is worth less than a dollar today. Not too much less, but a little bit less. A dollar a year from now is worth less than a dollar today because of inflation, mostly, right? So now and in the past couple of years, we've seen some pretty aggressive inflation numbers where the price of food, price of cars, price of houses, everything is appreciating at a pretty fast clip here. So that's a little bit unnerving. It's a little bit unstable too, but I think we're going to have to bear with this for a slightly longer time. But definitely inflation is one cause that creates the value of a dollar to be worth less 1 year from now than it is today, but also because you can take that dollar and invest it today and earn compound interest on it. Okay, probably not a dollar. You're probably not investing a dollar per se, but if you had $10,000 that would be worth a lot more today than in the future, because you could go to a bank and get a CD, and in the future it's going to be worth more than $10,000. Okay, so that's very much it, guys. Hopefully I was able to drop some knowledge. If you like these videos and want me to keep them up, please tell me in the comment section. Okay, and if you want different topics, I can certainly cover different topics. I'm going to make an attempt to cover more financial topics starting in 2025. So look forward to that. And if there's something specific that you want me to focus on, then just let me know in the comment section. So that's pretty much it. Thanks for your time today. Enjoy the rest of your day. Goodbye.